The sad but common reality of many people in most parts of the world is living from paycheck to paycheck. Each payday comes with short-term financial relief, but expenses seem to suck the earnings back to zero almost immediately. It means that one's income covers just his or her basic needs on things like rent, utilities, food, and transportation, leaving little or no money for savings or discretionary spending. It puts many on a very precarious cycle in which any unexpected expense, a medical bill, a car repair, can catapult someone into debt or financial hardship. Living paycheck to paycheck has propagated through income levels in recent years and has not affected just low-wage workers, but middle-class families. According to studies, nearly 60% of Americans are living paycheck to paycheck alone in the U.S. This class of financial instability is confined to no single country, but shows similarly in many parts of Europe, Asia, and beyond. Understanding its causes is important in addressing this pervasive problem. In this video, we go through the major causes that lead to the paycheck-to-paycheck lifestyle, a lifestyle having long-term consequences on the well-being of individuals and society at large. But before I get started, I want you to leave a comment down below. I am a successful and wealthy person. Positive affirmations bring more positivity to ourselves, so please comment, I am a successful and wealthy person. And when I see your comment, I'll give it a heart. Now let's continue. The leading causes of the paycheck-to-paycheck crisis are functions of increasing disparities between wages and an escalating cost of living. On one hand, wage growth in many countries has failed to keep pace with either inflation or the general rise in the cost of key needs like housing, healthcare, and education. This has set laborers under immense tension, even fully employed ones working on a full-time or multi-job basis, yet who barely make enough to make ends meet. Housing costs, in particular, have risen in exponential ways over recent decades. Urbanization and population growth force demand on housing in metropolitan areas, where the prices for homes and rent have increased precipitously. In many cities, rental costs have risen by double-digit percentiles, while wages have mostly remained flat. This means that a big slice of the income of persons and families goes to housing, leaving very little for food, healthcare, and savings. That result has been that many have been made so vulnerable that they cannot even build up a small financial cushion against emergencies. Besides housing, the cost for most of their other basic needs greatly increased. For instance, healthcare costs skyrocketed, medical insurance premiums, prescription drug prices, and out-of-pocket expenses continuously rise. Similarly, education costs have inflated, therefore students and graduates remain with huge student loans, which often take years or even decades to pay back. With these critical expenses taking a larger fraction of households' incomes, for many workers saving for their future or even building some kind of emergency fund becomes close to impossible. This is further compounded by inflation. While goods and services are appreciating in prices, idle wages are weakening in purchasing power. In reality, workers earn less even when salaries remain the same, for the fact that one can purchase less with a given amount. As groceries, transportation, and utilities get dearer, they add to the economic crush. The result is that stagnant wages and higher living costs have combined to imprison millions of people in a cycle of financial instability from which there is little hope of respite. It is also particularly well explained by economic policies in addition to the inequality in wealth. Over the last couple of decades, many nations have faced increased concentration of wealth, whereby a few of the richest in the population hold a large amount of the nation's wealth. This has been exacerbated by economic policies that favor the rich, thus putting middle and low-income households at a disadvantage. For example, tax policies have caused increased disparity in wealth. Most countries, especially developed economies, have implemented tax systems that favor the rich more. Tax cuts for high-income earners and corporations, loopholes allowing them to pay lower effective rates, have translated into accumulation at the top. Meanwhile, a greater part of the burden is laid on lower and middle-income earners through taxes, further diminishing disposable income and in turn saving. Along with tax policies, Another driving force for the recent widening in the wealth gap has been deregulation and market trends. Consolidation at the corporate level, along with the growth of monopolies in specific industries, has managed to reduce competition, thus increasing consumer prices while pulling back wage growth for employees. This has been coupled with corporations moving more resources to executive compensation and shareholder profits, while usually sacrificing wage increases for regular employees. The outcome has been extremely unequal distribution of wealth towards business owners and executives, leaving mere drips of actual economic growth affecting workers. Another source of controversy is minimum wage legislation. But for more than a half-century especially, the minimum wage has failed to keep pace with inflation, let alone the rising cost of living. Consequently, many workers at or just above the minimum wage lack the wherewithal to purchase such basics. Raising the minimum wage is one of those divisive issues, with opponents fearing job losses or higher prices for consumers. But for advocates, increasing the minimum wage is necessary to temper poverty and ensure that low-income workers have any chance at managing their economic constraints. The other avid contributor to this no-end cycle of living paycheck to paycheck is consumer debt. Thousands of individuals and families find themselves in a debt trap where meeting daily expenses is only possible through credit cards, personal loans, and other forms of debt. A dependence on debt brings down their capacity to save, while the tendency for financial vulnerability increases due to the payment of high-interest income that eats away at an already low income. Credit card debt remains one of the major concerns many households have to face. Whereas wages have stagnated and living costs continue to increase, more people have started depending on credit cards for the payment of groceries, medical bills, and utilities. The only disadvantage with credit cards is that they come at very high interest rates, which may easily spiral out of control should payments not be paid in full every month. The total amount owed by a person starts increasing as the interest accumulates, which further makes the debt cycle more difficult to get out of. Student loans are another influential factor that worsens the already poor financial situation of the young generation. Due to expensive higher education in colleges and universities, students are forced to take large loans for affording these expenses. This, for many, means the ultimate reality of graduating into the workforce with an otherwise insurmountable amount of debt that would take several years or even decades to pay off. Further, such debt often delays major life decisions about such issues as buying a home, starting a family, or saving for retirement. For most people, financial stability will be far out of reach because of student loan burdens. In addition, exacerbating the situation are poor financial management and a lack of financial literacy that contributes significantly to their living paycheck to paycheck. Most of them also lack the requisite knowledge and skills to handle their financial resources, which eventually turns into overspending, not enough saving, and improper investment decisions. Without proper knowledge with regard to budgeting, saving, and investment, individuals are more likely to be driven to live beyond one's means by making the deficit using credit. Predatory lending practices exacerbated the conditions. Payday loans and high-interest personal loans, packaged for those least able to afford them, promise quick cash with easy, seamless payback options. The catch includes astronomically high interest rates, sometimes as high as 400%, in loans that ensnare the borrower into a debt quagmire from which it is practically impossible to climb out. Where the gig economy has brought into existence another level of financial insecurity for millions, it allows workers the benefit of flexibility and supplementing their income. It allows huge problems among people for whom gig work is a primary source of income. Workers in the gig economy are often bereft of job security, benefits, or other common protections that would afford them a chance at financial stability. The gig economy, popularized in recent years by companies such as Uber and Lyft to food delivery services like DoorDash, has drawn millions of workers with the promise of flexible hours and the ability for contractors to make money on their own time. However, many of those workers are finding out that without health insurance, retirement benefits, or paid time off accompanying their steady incomes, they are highly susceptible to being put into precarious financial situations. Gig workers, in their turn, often find it very difficult to budget without a regular paycheck, with their financial security connected to market demand and unpredictable schedules. Precarious work is on the increase, it would appear, in most industries nowadays. Employers are banking more and more on part-time, contracted, or freelance workers with the aim of avoiding full-time benefits. The result is a growing army of workers who have unstable incomes, limited access to benefits, and little job security. Most of these workers cannot anticipate living on a sure paycheck for which one could plan the meeting of expenses against that expected income. One of the major challenges that gig workers in precarious employment face is a lack of benefits. Most traditional full-time workers depend on employer-provided health insurance, retirement plans, and paid leave in order to sustain their financial situation. In contrast with gig workers and freelancers, everything has to be out of pocket for such benefits, assuming they can afford to get these benefits in the first place. The cost of health insurance alone often makes it unaffordable, leaving millions of workers uncovered and one medical emergency away from financial devastation. Another factor contributing to the financial troubles in the gig economy is underemployment. While many of the workers have qualifications far beyond what they do, there are simply no secure full-time jobs open to them. All this, in effect, makes them drift to gig work or part-time jobs to afford sustenance, while most often making way less than what their qualifications could demand. This underemployment, besides no job security and no benefits, makes reaching financial stability pretty hard to achieve by workers. Social safety nets and government-assisted programs are designed to be financial support systems for people in need. In recent years, however, many such programs have been debated over for an overhaul, with conservative motions wishing to further weaken or restrict this aid from reaching millions of people who use it to avoid living payday by payday. The further weakening of social safety nets is thus contributing a lot to growing financial insecurity among workers. Welfare benefits such as unemployment insurance, food stamps, and housing assistance exist to help the most vulnerable people get by. However, slashes in these vital programs and heightened requirements were lowering the number of people receiving these benefits. Many times, working individuals receiving a full-time income, or even working several jobs, are not eligible for assistance yet are not able to meet basic needs. In other words, high barriers to assistance brought about by the complexity of the application process, the waiting times, and strict income thresholds remain a burden to many persons in need. Even when people are qualified for the help, it is usually meager support when set against the needs. For example, food stamp benefits are typically limited, and housing assistance is placed on waiting lists, a position that places many in precarious financial positions. Secondly, small-sized Social Security and pension schemes are the other probable factors that contribute to economic issues in old age and retirement. The unabated rise in cost of living has ensured that most retirees find their Social Security benefits or pensions inadequate to cover their expenditures. This forces some retirees to have to continue working, often at low-paying or part-time jobs, well into their senior years. Not having saved enough for retirement, many elderly are living paycheck to paycheck after years of hard work. Gaps in unemployment benefits further reveal the flaws in today's social safety net. Unemployment insurance will surely offer temporary financial support for the recently unemployed, but the duration and amount are usually very limited. In fact, many are too low to provide basic living expenses in most instances, thrusting individuals into a financially precarious situation. Moreover, eligibility for unemployment insurance may be very strict, whereby many part-time or gig workers are excluded from receiving assistance. Such a paycheck-to-paycheck crisis is multilayered in nature because of the special dynamics it presents across classes and demographics. Operating on an individualistic attitude of finance, systemic changes in economic policy are needed alongside social safety nets and job protections. It is, in fact, reassessments of current economic structures and active advocacy for policies spurring wage growth, affordable housing, and universal health care, all key components at the heart of earning security, reasonably well articulated by society. It is equally important to note that empowerment through financial literacy and access to proper resources becomes key in this manner. Financial education programs will equip individuals with the basic skills required for money management, debt reduction, and savings building. Policy reforms that ensure decent wages and job protections for workers are necessary to ensure no worker, regardless of employment type, is left behind in the pursuit of economic stability. In fact, solving the crisis of living paycheck to paycheck would demand focused coordination among governments, businesses, and the general populace. However, by addressing the structural and personal reasons forcing people into financial turmoil, it is very possible to build a future in which living paycheck to paycheck becomes the exception and not the rule. This would literally mean greater economic security, reduced stress, and improved quality of life for millions around the world. Hope you enjoyed this video, and before you get off, make sure to check some of my other videos. See you guys in the next video.